Hello, everyone, and welcome to our midweek update. This is Ahura. I will be with you with the market recap on Wednesday. Mostly, we're going to focus today on published data from Eurozone and also European inflation, and to see how they're affecting to the market. However, today I have to mention that in China, it's a Wednesday, and in China it's holiday. 1 week holiday starting in China from today for a week. Since we will not have investors and traders from China, we will have the lack of liquidity in the market, and it can create a bigger market volatility. So you should be careful about your trades and positions. Let's go forward. In Japan, so far we had Japanese data showed that the bigger industries or the huge industries, they had a better activities. And with this better activity, we can expect the Bank of Japan more expectation. We can have more expectation from the Japanese central bank to rate to hike the rates. That can increase the demand for the Japanese yen as well. In India, we had interest rate decision and monetary policy meeting. Nothing changed as market expected, held at 5.50% for the interest rates. Target rates. The national HPI, the house price index, the nationwide house price index in United Kingdom increased by 2.2% annually in September. On the monthly scale, it increased by 0.5%. However, let's go to most important data we had so far today. PMI numbers in Spain fell from 54.3 to 51.1. In Swiss, 49 slower to 46.3. In Italy, 50.4 slower to 49. In France, 50.4 slower to 48.2. In Germany, 49.8 slower to 49.5. And for whole Eurozone, PMI, manufacturing PMI slower to 49.8 from previous 50.7. In United Kingdom also, it was steady, it remained steady at 46.2, but at 46.2, very low numbers. This data confirms that the European economy is still struggling, and we shouldn't be too positive about the European economic outlook. These numbers say that if the central banks, if the governments, they do not follow positive and efficient economic policies or monetary policies and financial policies, we're going to have much more bigger problems in the Eurozone, even in the UK. These numbers say that the economy should be the first and the main focus for the policymakers, not just in the government, not just in the central bank, in government and central bank together. They have to work together, because these PMIs, it's not for 1 month, it's not for the 2 months, it's for months that we can see them under 50 area, 50 expansions area. These numbers are not good. These numbers are not signing something positive in the market. In Eurozone, we're going to have, we saw in the Eurozone, we have the inflation numbers. Inflation numbers, we can see the Eurozone inflation slightly increased to 2.2% from previous 2%. Slightly increased from 2% to 2.2% shows that while the inflation is low, but at the same time, the underlying concerns still there and growing. Core CPI unchanged at 2.3%. However, the 2% and 2.3%, they are not a number that we say that, okay, the central bank right now should think about changing the monetary policy, going towards the higher rates. No, the central bank in Europe should think about the lower rates, as what the National Bank of Switzerland, SNB, did at the 0%, cutting the rates to 0% and holding the rates there. These numbers shows that if the central bank doesn't support, if the government doesn't support the economy, we're going to have much more and bigger problems in Eurozone. German 10 years bond auction was at 2.7%. Bond yields increased to 2.72%, the highest rate since 2011. That doesn't mean that the expectations from the central bank is higher for increasing the rate for European Central Bank. No, because the European Central Bank at the current situation cannot raise the rates. What does it mean? It means that the rating of bonds slowing in Eurozone, especially in the countries like Germany, especially in the countries like French, and the governments and officials who they are publishing these bonds, they have to pay more profits to the buyers, more yields to the buyers to convince them to buy the European bonds. These numbers, if I'm the investor, if I want to buy the bonds from Europe, Eurozone, European bonds, if I want to buy, like just compare it, we have options. European bonds, Japanese bond, Chinese bonds, Americans bonds, and even go to Brazilian bonds, or even look at further, go to Indian bonds. Between all these mentioned countries and mentioned economies, Europe is going to be my last choice. With this economic environment, look at the economic growth numbers in India. That's much better. Even though the Chinese economy is facing too much problems, but still it's going to shows better reactions. Same thing in Hong Kong. Same thing, but the best is the Japan. Japanese economy is moving forward. Numbers are fine. Inflation is under control somehow. At the same time, expectations for higher rates is there. So higher rates, higher bonds, higher yields as well. I mean, the AAR triple A plus bonds with the higher rates. Why I should have go twice towards Japanese bonds and buy the Europeans? That's the problem in Europe, and they have to watch for that. Let's just see the reaction. Yeah, today we're gonna have just like some more data from the American and from the United States as well, such as the PMI numbers, such as the ISM surveys. And in Russia, also unemployment rate and Reuters is going to publish. They are very important to watch, but let's go and see these data, the published data's reaction in the market. Market risk after we know that let's start with the market risk. The market risk lowered increased to 18.20 earlier today, and after the government shutdown in the United States, and it's lowered to 17.70, and now again it's increasing slightly higher. Generally, the market risk is high. About the government shutdown in the United States, these games, yeah, it's the first time in the last 7 years. That's the first time in a Trump administration. All these things can be somehow, sorry to say that, but a bullshit. Both parties, they need the voters right now. They're getting so closer to the election right now. Both of them, they are looking after the voters, so they don't want to lose the vote. At the same time, the Trump treating the Democrats that if they do not confirm this budget, the government budget, he's gonna go forward and do the Doge. The Doge that they had some ideas before earlier to cutting the employees, the government employees. Governments no need employees, just like a bigger government. It created the democracy, created the government. So the Trump says that if you do not confirm the budget, I'm gonna go forward and cut these jobs there. So that can put the democracy much more under pressure, and most probably they're gonna confirm it today or the day after. So this is what's going on here. That's why the market doesn't pay too much attention on that. Maybe, yeah. But if it continues after more than a week, then it's going to be a problem. But for now, it's not a problem. It's not a big deal actually. As for the Europe, if you're looking at that, the European, the common currency, the euro, is getting weaker against other economies. That's what we are talking about. The weaker economic growth, while the central bank was expected to cut the rates to support this economy. All of this is putting they are putting the euro in the weaker position against its crosses. So Euro USD, Euro GBP even, Euro JPY, all of them here should be sold because the euro is going to be much weaker against its crosses. With this economy, I don't expect the euro getting weaker, just like being a winner in the second half of the year against none of the economies. As for the stock markets, like the central bank is going to have the more dovish policies. The markets are happy for that, but the happiness is coming from very weak and very negative idea. So this happiness shouldn't go further. I mean, I don't. If I'm the investor with with these economic data that I have in the Eurozone, I'm not going to invest in the European economies a penny. Yeah, maybe in Italy, maybe in Spain, maybe some in Poland, but but not in the French, not in the UK, not in even just not the Eurozone, but even not in the UK, not in the French, not in the Germany. These numbers says that we should be more careful about the data, and the uptrend in the stock market is not something that we can trust. Yeah, technically it's uptrend. Technically, we can see the RSI is still at 67, confirming that uptrend can continue there forward. I mean, just that the trend is going there. OBV confirming the buy position is increasing, but that's what the technical data says, but it's not what I can understand from the fundamental from the market. Same reaction we can, as for the cryptocurrency market, if you go to the crypto market, you can see that the crypto market says, where is that? Yeah, is it a Bitcoin? The crypto market should be happy for that. Yeah, we can say that with these numbers and with these data, markets will have some cash out from the stock market. We'll have some cash out from the stock markets. And this cash out from the stock market, not just from the Eurozone, if you go forward and you look at the American stocks, S&P 500, Dow Jones, Nasdaq, all of them. This crash in the market, this we can say how can say that the scares in the market, the worries, the concerns in the market can increase can slow the demand for the stock markets, and the outflows, the money which goes toward the gold. As you can see, the gold 2,900. It goes toward the stock. It goes toward the cryptocurrency market, and the Bitcoin again about 116,000. So these numbers in the Eurozone is negative for the euro. It's in a first reaction positive for the stock market, but in a deeper number, I don't think that's going to be positive for the stock markets in the Eurozone. Generally, the euro positive for the gold. It can increase the demand for the gold against weaker economic growth in Europe, and also increase the demand for the cryptocurrencies. That was the market data and expected reaction. Have a good time. Bye-bye.